Hello traders, welcome back. It is Patrick. It is day 5 of your 18-day boot camp series. I'm excited about today because today is when things start to heat up, when we're about to learn a lot of information. I must say today's video is typically one of the longer days, one of the longer sessions. One of the goals with the boot camp, as I've mentioned, is not only having a solid course with a lot of information, but a course that you're able to follow along and learn at a pace where it's not overwhelming, but also you're learning a lot of information. And so I try to keep these videos to a point or 2 points each. I don't want to overload you guys with information. But under basic trading principles, we have a lot of information to cover today, and a lot of good information. And today, even though it says basic, the most advanced traders will still learn a thing or two, as we have some techniques inside of CPSG that it's just simple, not a lot of people utilize or even know about for that matter. So today's is very important for you guys to take some notes. Utilize all your tools, whether it's the screenshotting or workbook or actually just a notebook, whatever the case may be. Make sure you're taking some notes because today is going to have a lot of information. Some of it's extremely basic, but we have a ton of basic traders, as well as some of it's more advanced, and I'm excited about getting into it though. So let's get started. First things first, what we're going to discuss today is directions in the market and what a directional trading means and trading directionally and things like that. So first, as we get into it, what we need to understand is the directional markets. And the first direction and the directional market that we have is an uptrend or a bullish market. And by textbook definition, it's defined as a location in the market that is making higher highs and higher lows. Meaning that when the market is going and it's starting to do these pullbacks, this is considered a high, this is considered a low. Each time it comes up and does one that's higher. And you can connect these dots and notice that each dot is collectively higher. And so when you find these areas in the market, it's moving in an upward direction. And we only look to, of course, buy those dips. Each time that market comes down, that's where the opportunity lies. We're not looking to reinvent the wheel and try to get lucky shorting this market. We're looking to trade with the trend and buy those dips. And it's a bullish state, like I mentioned, right, in an uptrend market. And so it's just simply the rallies in which the next rally is exceeding the previous rally. And so that's the textbook definition. Let's see what this looks like on a chart. As you can see here, I have HH defined as higher high and HL defined as higher low. And so as you can see, this market is continually producing a higher high and a higher low, and a higher high and a higher low, and a higher high, etc. And so this is a bullish market. It's in an uptrend. It's only moving upwards. And so you want to make sure that you're looking in this case to find the opportunities in these dips after the market's coming down. And of course, that's just all that's needed for you to know right now. We'll discuss how to actually get entry and things in the coming days. But understanding that you have to be able to find these trending markets is the first. So whether you know it or not, you want to be sure that if you looked at this as a blank chart, you want to make sure that you know that this is a bullish market. This market is in an uptrend. As you can see, the market enters the picture here. The market exits the picture here. Which line is higher? If we connect them. This one, right? Meaning that this is in a bullish market. This is an uptrend in this current segment. Now, this is only to do with the 60-minute, 1 hour time frame chart. This is a 1 hour time frame chart. Every chart is going to have a different trend. Whether you're really zoomed in, you're on a 5-minute or 1 minute, or on a monthly chart and we're looking at massive economies of scale. Every single chart is going to have a different trend. And so understand that you'll be able to identify the trend per time frame. And understanding the trend is going to help you at least be in the correct direction. And you'll be in the right directional bias for the market. So this is, of course, an uptrend, and you guessed it. What would we do next? We'll, of course, discuss a downtrend. It's the same thing, but reversed. It's when the market is moving down, followed by these lower lows and lower highs. And you're looking to sell these peaks. Just the opposite. And you're looking to sell the rallies. In a downtrend, we're in a bearish state. Once again, if you forgot what I mentioned, bullish is like a bull. What does a bull like to do? They run at you and they ram their heads up. They ram their horns up. They're bullish. Whereas a bear, what do? They bear down on people. When we hear bear attacks, people are in the fetal position and the bear's on their back going after them, going down on them. That's a bearish market. All right? And so finding and defining a trend is very, very important. And so once again, this is a bearish market, and it means that we're moving downwards. So here's what it looks like from a charting perspective. As you can see, lower low, lower high. Lower low, lower high. And what I mean by lower low and lower high is here's a high. This one's lower. Here's a low. This one's lower. And they continually to go lower and lower and lower. And then, of course, we have this trend line to show you where the direction is generally heading. And you can see the market entered on this side and exited here. Which one's higher? Of course, this one's higher. This one's lower, meaning this is a bearish market. It's going downward. From a picture standpoint, this is what that simply looks like. It's just continually doing the same thing, and this is just either or. Once again, these are just some market principles you need to understand. When somebody asks you a question, if you're in CPSG, for instance, if we bring this from a learning perspective to a business perspective, and you have a potential client that wants to join CPSG and they want to learn about trading and they're asking you trading questions and they want to ask you, what's the difference between a bullish and bearish trend? I think you're probably going to want to know the answer. Well, now you know. A bullish trend is up, bearish trend is down, and it's defined by a lower low or lower high. Now, you may be asking yourself, Patrick, what if the higher high, higher low doesn't always work? What if sometimes it's higher, sometimes lower, and it's not very clean? Well, there's an answer to that. If you find a market that you can't really define that, typically it's a consolidated or sideways market. So let's discuss what that looks like. So a sideways market is also known as consolidated market. You'll hear people say the market was in consolidation. And it basically does not offer a clear path of, a higher high or a higher low. And it's all over the place. So you see here, here's a low, here's a high. And so notice how, they're breaking each other. They're just random, right? And so you can't really define a trend. It's very difficult to define the trend. And so what I want you to do is understand that a lot of people will, and if you don't know this yet, a lot of people will avoid. They will, they'll say, we're in a sideways market. Let's wait till it gives us clear direction, things like that. Now, if it was up to me, if we're playing only on the safe conservative side, that's probably the way to go. And that's probably what you should do, to be honest. However, there is opportunities, contrary to belief, that provide some decent setups. And this will involve trading off the range of support and resistance. Now that's a new term, support and resistance. And of course, we'll get into support and resistance in a moment, but I want to get into what that means for a second. Now, support is a point in the market where the chart hits it multiple times. And it's at a low. It's at the bottom. Support is the chair you're sitting, or the couch you're sitting, or the beach chair, or the lawn chair, whatever you're sitting in right now. That's your support, right? Now, resistance is a ceiling. It's this reversed. So when the market hits a place multiple times to the upside. Now, as you guys know, and we've talked about this, why does the market moving? It's all to do with buyers and sellers. It means there's a lot of buyers just chilling here, and they continually buy the market when it comes up here. And then this same thing on the other side. It means a lot of sellers are sitting here, and they continually push the market down every time it tries to come up back again, right? So this is support where the market's sitting, and this is resistance where the market keeps hitting over and over and over again. And so first you need to understand finding it. And so to do this, we're not going to rely on just one line. We're going to use a rectangle tool, okay, to use a general zone. And guess what? I just taught you in day 4 yesterday how to use the rectangle tool and how to make it so that you can make zones. I mentioned that to you. Don't say I didn't mention that. I told you it would be coming quickly. And so we're going to get right into how to do some of this information here in a minute. But here's an example of a sideways market. Now, the great thing about sideways markets is history has repeated itself a lot. When you have a sideways market, such as you see the picture above, history's repeated itself a lot. Before you entered that sideways market, you want to ask yourself, what direction was the market predominantly heading? Up or down? In this case, what you'll notice is that this market was heading up. History's repeated itself a lot of times, that once it gets through this consolidation phase, the market then continues the direction it had started before the consolidation phase. Okay? Use that right there as the biggest nugget of the day as a great tool for general trading, to understand general zones. Okay? So this is where we got to start looking, is we have to start looking prior to the support, prior to the resistance, prior to even knowing this was a sideways market. This was a trending bullish market. We need to understand that there was a higher high, higher close before doing that. Now, we're only looking at this time in a sideways market, once again, to trade off of support and resistance. But what did we talk about just a few minutes ago? We mentioned in a bullish upward market, what do we look to do? We look to buy the dips. So if this is a bullish market prior to a sideways with support and resistance, what would we be looking to do in the sideways market? We would be looking to predominantly buy the dips off of support, not looking to sell any of these. We're not looking to short any of these rallies because predominantly we know the direction of the market. We have a bias in this case that the market is heading higher. And so since we have that bias, we're looking to buy these dips. As you can see, here's a false breakout, then it heads higher. And so these are presenting us with small opportunities. And obviously this is an hourly, so this is basically as minimal as you'll get. You don't want to go too much lower than this for a sideways market or else it gets way too intricate. But when you're on a weekly or a monthly sideways market, which heck, we've been in tons of these in real time, when you're getting that on a weekly or a monthly or even a daily, it's a great trade setup because in general it's rejecting, and it's rejecting inside of these bigger zones. It gives you more room for some more profit. All right. And so what we do is we utilize the directional bias to know what we're going to be doing. So if you're asking yourself what you should be getting out of this so far, is understanding what direction you should be trading. If we're in a bullish market, what should you be doing? Buying the dips. If you're in a bearish market, what should you be doing? Short the rallies. Yes. Either or. And that's continual basis what you need to be doing. So next is understanding. We're about to get into a lot of crazy stuff here. So things are about to heat up. As you can see, we're going way faster pace than we were in the prior as far as just amount of information being thrown at you. And it'll continue to be like this now. So make sure that if you're not with me, rewind, continually try to get and understand it, take some notes, write yourselves questions, things of that nature. So now we're going to talk about breaking of a trend, because we just talked about the trend here. Here's an example here that you've already seen this picture in the bearish picture. And now this is that same picture zoomed out. Notice when it broke its trend. Okay? So breaking of a trend is a vital skill to be able to classify when starting, just to learn some basic trading strategies. When a trend breaks, an opportunity is always near. A break of a trend is when a clear bullish or bearish market does not continue its pattern. And so here is an example. We have an original high followed by a lower low, lower high, lower low, etc. Okay? We get down here, and suddenly what you'll notice is that we kind of reject off of this trend line. We break outside of this trend line, which of course we haven't even taught you how to draw those yet, but we will. We break outside of this, and then we head higher. Here's the lower high. What happened? X marks the spot. It was broken. Followed by a higher low. Once this happened, it signified to me that the trend direction is changing. this is a great opportunity to try to start to take advantage of a trade in the opposite direction. And so when you're marking your charts, always be wary and cautious of if you're in a trending market or a market that's recently had a break of a trend. To be able to do this, utilize your trend lines, which of course is coming in the next few minutes. Utilize your trend lines and utilize this. Utilize your circle tool or just label them with your text tool to be able to mark these charts up and understand what direction the market is going. Once it's broken, notice what are you doing? Higher high, higher low. Now we signify bullish market. We're no longer looking to short. Now we're looking to find opportunities to buy the dips as it heads higher, to buy the dips as it heads higher. Okay? So one thing that I keep doing in here with you guys is support and resistance. And so what we're going to do now is now we've learned how to dictate trend and to label lower low, lower high, etc. We're really starting to get to know how to label this information. Now what I want to do is move forward to know how to start to label support and resistance. Now, support and resistance is extremely vital to your success. And marking them successfully, clearly, and easily is going to help you. So, first things first. Understand, support and resistance are key levels in the market, and they're so vital, as I said, to your success. And so these are levels where price may support, meaning it's below, or where the structure may resist, meaning it's above the overall market structure. Support is like a floor. Resistance is like a ceiling. I always make the joke, if I jump in the average Joe's house with an 8 or 9 foot ceiling, I'll hit my head because I'm so tall. And then I always say the thing I'm sitting in is my support, and when I jump and hit my head off the ceiling, that's the resistance. And so understanding that is the first most important. You got to understand which is which, just from a terminology standpoint. And so the best areas of strongest S&R are those what were once support and became resistance, or vice versa, which you can see depicted in the picture over here. So this picture is important, and you guys need to take note of this picture. Obviously, some of you guys are working alongside with me in the workbook. Make sure you have a copy of the workbook. If you don't, what we have is a printed version of this course, and it gives you insight, and it also has all these printed for you, so you don't have to print them, you don't have to take pictures, as well as gives you white space to take notes. It's going to be vital to your success. Make sure you get that. And so, once again, what we have on the left side is basically a color guide to how we do things. We mark our minor S&R, either support or resistance, doesn't matter, in orange, and major in red. Okay? And we'll discuss what that means in a minute. But we label each level by color coding how strong it is. Red being strongest, and orange being a little weaker. And the reason we do that is that if you can get in the habit of marking some minor ones, you won't get as giddy at opportunities. But if you have a great opportunity, great chance at a red zone, a major support or resistance zone, it's going to give you that much more reason for entry. And it's all about stacking your reason for entry. It's all about stacking up why you're going to enter the trade. And so I like to do systematic things, and that's why I designed the course the way I did. So first of all, it does not need to be complicated. Please do not overcomplicate this. So there's just a couple steps you're going to need to follow, and we'll go through this. Step 1 is mark your S&R levels on one time frame higher than you plan to trade on. For example, if you're planning to execute a trade on a 1-hour chart, meaning you're planning to enter off of a 1-hour chart, mark the support and resistance on your 4-hour chart. To do this, go on your 4-hour and simply place horizontal lines at areas you see being tested and creating these levels. So if you saw a market that looked like this, what you do is you simply look at what's going on. I see a market doing something here and here and here and here, and you're just starting to mark these, and we'll go through this. But you're just starting to mark, where did the market have trouble? Where did it rebound? Where did it bounce? And you can get as intricate as you like, But that's sometimes the issue with people's trading, is they tend to get too intricate with it. And I'll show you how intricate I get in a minute. After you've done the horizontal line, which I've taught you in day 4 how to use a horizontal line, you're going to then use a rectangle tool to color code your levels based off of intensity. Use these as basic guidelines to the market for the rest of the trading strategy that we'll implement as this 18 course goes on. Of course, this is our first day of strategic talk, and this is just getting us ready to mark up our charts. We haven't even implemented the strategy. So following your trend defining procedure, you learned earlier, this will become your second step. So as you've done this, what your first step should be is defining the trend, and then this is going to be your second step. So let's take a look at this on a chart. So here's on the left a chart. This is step 1. Okay, step 1 is pretty simple. We're using our horizontal line, which are those green lines, to mark major zones. So from a major zone point, I saw hits here, hits here, hits here, so I marked that one. And then I see a hit here and a hit here, but also a ton in here. And then I also saw a solid hit here and in here, and then also, of course, I saw this bottom. So you notice I didn't get too intricate, meaning I didn't go in here too often or here. I'm marking the extremes, the ones that have been hit as multiple times. Okay? The ones that have hit multiple times. So after I've marked this, after I have my horizontal line, I'm now ready to start using the red and the orange. So how we do that, before I even go over there, then I'll show you, is very simple. When they're red, it means the market's been hit in the same direction, meaning resisted twice in the same direction. When they're orange, it means the market's in the same direction only once. So I can bet this is orange, and this is red, and this is red. Okay? Now, this is one direction here and one direction here. This is the change of direction. And so in some cases, there could be confusion, but this here, this was support, this was resistance, same zone. Even though it's technically off the same level twice, I want you to mark that orange. The only ones that are marked red are if there's such as like a double bottom, when it's hit twice or 3 times. So on to the next. Here's the second step. What I do is I mark up my zones. So my zones are marked, once again, color-coded, and they're based off of how many times it's been hit in the direction. And so you'll notice that I color-coded these areas. Notice the zone is just basically the wick. Here's the top wick into the candles. I don't get too intricate. This does not need to be intricate. Everybody needs to have, the equation. And that's, when I do one-on-one consulting with members and I talk with them one-on-one, the number one thing that nearly destroys traders is the fact that you've gone to school for years and you've been taught that if you use an equation this way in math class and you do it correctly, you're always going to have the right answer. Whereas with trading, there is no correct equation, there is no right answer. It's speculation. This is you and the market. This is how you interpret the market. This is how you do things. And finally, to that point, when I walk in the market, I could mark up the chart the same way every day, potentially quote-unquote correct. Just because I do that does not mean I win every trade. And that's why, of course, day 2 was talked about so early on. We want to be able to not only lose trades, but lose plenty of trades and still make money. So we take advantage of the risk and the mathematical side of things in that nature. Okay? And so now that we have this marked, this is giving you a good idea where the market's currently at with the trend. We have no trend lines even yet. We haven't marked any of that. But this is now giving me a great sample piece of where the market could potentially bounce. And so if you're in between these areas, obviously where price is right now, I'm not sure. But if you're in between these areas, just in the middle, maybe you don't trade it. But if you're near one of these areas, you look to buy it. And so you're potentially starting to look for opportunities now. And so you got to think of these lines as magnets. When price is near, the touch is nearly always inevitable. And so breakouts are important, and we'll discuss that in a little bit. But this is so important, so vital to your success. Understanding these rejection zones. Color coding them appropriately. so you understand the strength. Okay, so here's this picture blown up now. Great picture for an example. And so I highlighted what I was kind of looking at in yellow first. And then, of course, we went to the green, and then we color-coded it. And so what you'll notice is in here, resistance is turned support. This red box, resisted price. When it came back up, supported. That's common, and that's okay. And that's what you want. And so all we do is color coding them, and once again, there's no right or wrong answer. You're going to have to go practice this in the market. You're going to have to go out there and do it. You're going to have to go practice and go and go and go. But marking these at the beginning are going to be vital to your success. So every time you're looking at the market, even squint, use my trick, squint, and find the major zones. What I see from a major zone is like this. These are major zones. So this is what you should be marking. These areas, these areas, these areas. That's what you should be marking. And so if you're asking yourself, why don't I mark this little guy and this and this and this? The reason is that's a lower time frame. Those are more intricate levels. Your goal is to look at your level. Your goal is to look at your time frame. And so you're trying to make sure that you're utilizing these time frames better than anyone else could. And you're doing that by not paying attention to these short-term areas. Because if you zoom in, then you can look at them. Pay attention to just the outskirts. Pay attention to the outline. The major zone. That's your important point. Okay? So now, in your basic market principles, the goal of today's video, we're not done yet, by the way. This is not ending it. I'm just trying to recap for a second, is to, of course, teach you how to define trend, how to find support and resistance, and how to use trend lines today, and then of course put it all together, just so you know. So we've just finished 2 of those. Now we're going to go into point 3, which is of course now discussing trend lines. Trend lines are another basic tool used by traders to find moving support and resistance. Same as what we just talked about, except for it's moving. It's more dynamic. In CPSG, similar to SNR, we are using very basic version of these, only defining very major areas. Keep in mind, the reason we do this is you guys are in for a treat, because you're going to learn how to not only trade structurally, which is what you're doing now, but you'll also be learning how to trade sequentially over the course of the next days. And sequentially is how we actually enter. We don't even enter off of what you're learning. You're just learning this so you have more reasons for entry and more reasons for your trade. So a trend line is the connecting of 2 or more lows or 2 or more highs with the lines projected out into the future. Typically, traders will use these lines to find the trade areas for the future. So what this looks like is this. Here's a bullish trend, no different than what you just talked about with trend actually being there, with an actual trend, bullish or bearish, no different. But we're starting to learn, how to utilize these trend lines for breakouts. Here's our bullish trend. There's a couple trend lines in here. How to utilize these for breakouts. Same with the bearish trend. Okay? And so, what I want to teach you today is how to draw these in a systematic way. Okay? So, first things first, you must draw a trend line from at least 2 or more valleys or peaks. From wick to wick. Can I highlight that? Can I make that important? A lot of traders make that mistake. From wick to wick. Now, as you know from the candlestick section, this is a wick. Right there, that top is a wick. Meaning this is your trend line. You're drawing from the top of this to that. You're not doing this to this. Not body to body. Wick to wick. Okay? Always wick to wick. Okay? When the price is moving in a bullish market, you're drawing from valley to valley. Bullish, valley to valley. When it's in a bearish market, peak to peak. Okay? Make sure that the line you draw is not broken by any candle in between these 2 points, or else it's invalid. Meaning, if this is your line, and we'll of course show an example, but if this is your line and then you had one more candle in here, and its wick was breaking through this trend line, that's an invalid trend line. You want to make sure your 2 points when you first draw it, are wick to wick with nothing breaking it. If it breaks it, it becomes invalid. It's a different trend line. You're on a completely different pace. Okay? So let's start looking at how to do these. And now things will get a little more quizzy. You're going to have to start thinking quite a bit now. So here's a basic bullish trend line followed by a breakout scenario. So see, I have the wick at the bottom yellow. Right here. Top yellow. And then, of course, I have a wick here and a wick there. And I drew it down. Similar to this last slide here, same trade setup, but in real life. We know it's bullish. It collects. Once it breaks out of that trend line, we're looking to buy the dips. We're looking to buy the dips, specifically after it gets done with this orange resistance zone. Okay? So you can kind of see the charts start to come together. Once again, wick to wick. Do not notice nothing in this line, nothing all the way up, is invalidating or breaking this point. There's nothing. Okay? So being able to draw these are vital. So being able to define trend lines may seem as easy as S&R, but for a beginner it may not be. So what I'm going to do is I'm going to change paces now. For the following pictures, test yourself if these are right or wrong in terms of how they are drawn. So I'm going to start quizzing you. Once again, the goal of the CPSG course is not only to provide you information, but to be dynamic enough to quiz you and actually see if I'm pushing you to actually understand the concept. Majority of people won't even finish a course. But if I can make sure that you're understanding the concept day by day, you will. So let's look at the first example. I'll take some time here and kind of walk you through it. I won't give you any hints. But I just did an example of drawing a couple trend lines. And what I want you to do is to quiz yourself from what you just learned if these trend lines are drawn correctly or incorrectly. Don't overthink this. So I drew it from the starting point here. Notice it starts on the wick. And then I drew it to the second point here. And it continues out. All right, so take a look at that. As well as started on the wick here and came down to this wick here. And it continues out. So, beginners are going to have so many different things coming in their head. You know, is it right? Is it not? Once again, what we talked about in just a second ago, we talked about make sure from point 1 to point 2 of the trend line, nothing is breaking the area. Is anything breaking above? No. So then second line, point 1, point 2, wick to wick, is anything breaking? No. So theoretically, it should be all right, correct? Or is it? No, I'm just trying to push you. It's correct. That's how you're drawing it. Okay? Wick to wick. And you can draw these all day long. If you're wondering why this one isn't drawn, it's just because I didn't draw them all. There's opportunities left and right as we draw these. Opportunities left and right. We could have drawn bottom ones. We could have drawn channels and things, which of course that's part of the more advanced side of things. And we'll get into that. But just for now, just learn how to draw a trend line. Okay? Let's do it again. So, point 1 is here, point 2 is here, as well as another point 1 for this and point 2. Okay, so we start here, wick, comes through, wick, continue out. This one, start here, wick, comes through, hits it, point 2, continue out. Right? Okay? So take a look, quiz yourself, and I don't want you to just use this as a time to just chill out and wonder. Look at this. Take a minute. Quiz yourself. Think, is this the case? Is this correct? All right, yes or no? Final answer. No. Now ask yourself why. Ask yourself why. Of course, the only reason I'd put a no, the only reason I'd put it wrong is to just easily be able to help you guys understand. Well, first of all, this one is correct. Point 1 here, point 2 here, starting, hits, nothing in between. Where this one went wrong was right here. Because we had the trend line, but if you were to draw the true trend line, it would have started here and gone out to here. It would have been much lower. Okay? Never break from point 1 to point 2. After that, this doesn't matter. That's the projection. That doesn't matter. You want to make sure your point 1 and point 2 do not have anything that breaks in between, meaning this line here the space from this point to this point, when you just start to that second point, on both occasions, nothing breaks outside of it. Things can touch it, but nothing breaks outside of it. Okay? How about again? Okay, start here, just one line on this one, zoomed in. Here's starting point, here's point 2. We start here, we draw it down, hit the wick, come through, nothing breaking. Okay? Once again, after in the projection, this doesn't matter. Don't let that confuse you. Okay? Yes or no? Yes or no? Think about it. Take a look. Wrong. Now, this is the more difficult one. And a lot of people, you know, that I've gone through the course with, excuse me, have gotten this one a little more confused. And they tend to confuse themselves on this one. So, why? Well, why this one is wrong is wick is here and the wick is here. Okay, so it needed to draw a little bit higher. Okay, needed to be higher. Wick to wick. Never cut through it. Never cut through it. So this one was confusing because there was nothing protruding this line. And this, I think you guys got that gist now. That doesn't matter. But the wick is important. So top of the wick to the top of the wick. Once again, top to top, top to top. That's how you want it. That's how it always should be. Okay? So, applications of these concepts will be key to your success, which is why we only cover one concept at a time, which is why this has been slow. So far, you have learned 3 key concepts: how to define trend, levels of support and resistance, and trend lines. There's so much more to cover, such as basic EMAs, channel trading, and Fibonacci. However, we will now implement only these 3. I'm not saying you won't learn the rest of that, but we do things at a certain rate to keep it learnable. So I'm going to implement only these 3 segments in today's what we call the markup challenge. We'll now mark up a few separate charts that we have learned thus far. Remember these steps: trend, S&R, trend lines. Trend, S&R, trend lines. S&R being support and resistance. So everybody's going to start with this blank chart. Once again, it's white now. The only reason it's white compared to the rest of them is because I want you guys to practice this. For those of you guys that have the workbook, you can always draw on that workbook and try that. For those of you guys that are on the screen, feel free to print this out. But here's an example. Here's a markup challenge. I want you to try to mark this up. And so take a look at it. And the first thing you want to identify is origin point, where you're going to start your trend analysis, you know, where it's entered and origin points and things like that. And you're going to have to start marking this up. Now you can probably already get a grip on what the trend is. It's pretty general, and it's, you know, I'm not trying to grab the most confusing chart of all time. But the first thing you want to do is start to label your higher highs and higher lows. Once again, start to label your higher highs and higher lows. So, as you see here, step 1 will be identifying that trend. So I'm not going to waste too much of your time. I want you guys to do this. Pause this video, start marking up. And we're going to move on to completion of that first step. So we identified origin point, and then I just started to identify the higher highs and higher lows. Now notice in here we have a higher high, higher low, and all the way up. We get way up here on a higher high. I'm always marking off the wicks, notice. And then suddenly we get a lower high, and a lower high, and then a lower low. So that's telling me that there could potentially be a trend direction change happening. I can't guarantee that, but that's what that's signaling. So that's why it's important to mark these up. Okay. So if you remember right from this overall video, and I know this video, once again, this is one of the longer videos and it takes some time to do this. If you remember right, what did we do? The first thing we did was we labeled higher highs, higher lows. We labeled the trend. So this one is defined as a bullish trend, and it may be changing right now. The next thing we did was what? Support and resistance. But the step 1 of support and resistance was only the trend lines, or I'm sorry, was only the horizontal lines. So here we are identifying just the horizontal lines. We're identifying just the horizontal lines. Okay? Now notice in the markup challenge, I got a little more intricate with it. We're on the 4-hour time frame, potentially looking to take some trades on the 1 hour. So here we are, once again identifying easily across the board here what things look like. Each line continually. Okay, and then what we have to do is we have to look at it based off of how many times has the market hit that zone. How many times has the market hit that zone? And that's when we bring in our color coding. Okay, we bring in that color coding. The color coding is going to help us to find more intricate opportunities. And the reason this is important is you're always marking up on past data, but these things will shoot out into the future. And believe me, traders are all around the world are utilizing the same information. So when one trader sees a support zone, then thousands do, and that's why a support zone exists, because all traders are thinking alike. And so you're trading off of these zones, and you're analyzing this part. All right. Today we're just teaching about analyzation. We're not talking about entry. It's all about analyzation and getting yourself ready to mark up some charts. And just marking a chart will feel good. And hopefully this already is making you feel good. Okay? And then what do? We talked about our S&R. We talked about just adding the horizontal line and then putting in the intricate basis of it as far as the levels, whether they're orange or red. But then what do? We talked about implementing trend lines. Okay? So then we implemented the trend lines. In green there is where they've met, where the lines are. And now these lines are providing, notice this, where these lows are starting to come. See that? Projection-wise. And so we'll watch that. We'll see how it reacts above the resistance. And so you can start to see how these things are coming together. It's projecting price out into the future. Okay? So that's how a markup right now with the information you have learned should come together. Okay? That's not it. We're not done. Let's do another one. So here's a completely opposite type thing. This one should be super simple. It should not be very difficult. What direction is this generally heading? I think everybody and their mother can probably see that this is generally heading down. So the first thing you want to do, once again, is identify a starting point that you're going to work with, what we call an origin. And then we start to look at the higher highs and higher lows. We're looking at the structure levels. Okay? We're looking at the structure levels. So step one, we identify those levels. Once again, I'm not getting too intricate. I'm just finding those major peaks. I could have gotten intricate in here and identified these, but notice we're just on the 4-hour. We're not trying to get too intricate. So that's one thing that I can tell people that they will struggle with, and that's it, is how intricate you're getting. Now what you want to do is work out these lower lows, lower highs. And there was actually a lower low below this before its trend direction switched. So that's why that says higher low. I just recognized that, but I didn't put the rest of the chart in. So understand this. Don't let that confuse you. If you're just looking off of this picture, this would technically be a lower low. Prior to this was a different low, so it was a higher low technically. But anyway, back to what I'm saying. We're identifying everything, okay? Once again, we're identifying it. Notice things might start to switch here again. But step one is done. We've identified it. Step two, horizontal lines. Once again, getting as intricate as we can, but just starting to identify it from a structural basis. This is going to allow us to project out into the future what may be happening. This is very important information to take down and learn, because this is now, as you can probably tell, things have cranked up. And you're going to have to understand this to get into day 6 and day 7 and day 8, etc. So once we've done this, once we've identified this key levels of support and resistance, we've started to click that around, then we move in to our S&R levels. Color code them. Now that we've started to color code them, you're probably starting to get a glimpse of kind of why I'm color coding the way I am. Okay? And multiple hits in one direction constitute a red. One hit in one direction constitutes a orange. So in this case, one hit, but both of them are just one direction. So it's orange. One hit, orange. One hit, two hit, red. So that's how I do that. One hit, two hit, red. etc. Okay. Then we add our trend lines. Okay. Then we add those trend lines. Notice starting point, wick, then we can cut through whatever. Then it's projection. But we got to go wick to wick. Starting point, wick, cut through whatever. Starting point, wick, cut through whatever. Using these as projections, and then as market comes down into these, look for rejections and breakouts through those as we've talked about. Okay? Vital, vital, vital to your success. Okay? So these three areas are super, super beginner basic concepts. In day 6, what I'm going to do is open up some intermediate principles. And intermediate is my term for it, but I know that there's a lot of advanced traders that won't even know some of the information I'll talk about. In day 6, we'll discuss how to use a broker book and volume analysis and more intricate stuff. But day 5, this is so important. So what I challenge you to do is start to mark up some charts, okay, and send your charts marked up with just these 3 steps to me. Send your charts to me, to my Facebook or my email, whatever you got to do. You know who I am, you know where you can find me. Send your charts to me. I'd love to see you guys do that. Maybe I'll give a couple of you guys a shout out, put some together, and post some. So be sure that you mark these up and practice this. This is not just a course to just go through, listen, and go, okay, well, yep, learn a little bit back to what I was normally doing. This is to actually learn it and implement it. Learn it and implement it. So this was very basic, but this is getting in, to some stuff. So if you're a beginner trader, this should have been an overwhelming amount of information. You should have the need to go back, watch it again, take more notes, understand a concept twice, and get used to it. Okay? It takes a lot of time to get through. It's not easy to get through, but it's important to get through. Okay? So mark some charts up, and I will see you guys back here for intermediate market principles, which will cover a lot of great information in day 6. Thanks, guys, for your time.